So now we're going to solve COMM 217 Fall 2011 midterm question number 3. So this question gives us, we're going to start by looking at our requirements, which are right here, which tell us that we need to prepare the adjusting journal entries as at December 31st, 2010. So it's always important to note the date. So adjusting journal entries, December 31st, 2010, for these items that are seen above. And then they would like us to also mention if we do not need to make a journal entry and why. Then we need to prepare a multi-step income statement and an asset section only of the classified statement of financial position or balance sheet. They also want us to calculate the remaining life of an equipment that we'll read about later. And they want us to calculate the net profit margin and the total asset turnover ratio. So let's go back to the question and see what they're giving us. So here we're looking at the unadjusted trial balances as at December 31st, 2010. We can see here we can read through these quite quickly and see what we're given so far. Note carefully prepaids. Often adjusting entries will involve adjusting prepaid accounts. Why? Because we've prepaid, but then we've used some of that amount. We've incurred an expense, so we need to decrease that prepayment. Also at the bottom, they say that the total assets as at December 31st, 2009, which will be used in part 5. And they also tell us that no shares were issued, which will be important. So we could look at these and total assets. These are things to remember. They mentioned that the perpetual inventory system, that they use a perpetual inventory system as well. Therefore, a perpetual inventory system will not require the same kinds of adjusting journal entries as a periodic at the end of the accounting cycles. So to begin, let's look at our adjusting journal entries for A. So as at December 31st, we have $4,000 of wages that are owed but not paid for. So the first thing to do is to start and make our first adjusting journal entry, which means that as at December 31st, 2010, we're looking at a debit of an expense. When we debit an expense, we increase it. So wages, expense, and we are crediting wages payables of $4,000. Let's look at part B. The note receivable was obtained on September 1st, 2010. The note carries a 5% annual interest, so 5% to note receivable, and it's gotten on September 1st, 2010. And no entry has been made. So now we need to calculate the amount of interest. Now it's important to note that in this question, we are looking at, again, December 31st, 2010. Now we're dealing with a note receivable, not a note payable. Therefore, this is an interest revenue or an interest income. So we know we have something that's due because they haven't given it back to us. So we're going to deal with interest, receivables, and interest income, which is a revenue account. So we're told that this amount is for 200. We're told that this amount comes up to a total of 5% on the note. We know here, if we look back on our accounts, that the note receivable is of $1,200. So I'm just going to take that away so it doesn't confuse us, but as you can see, it's $1,200. So let's go back here, and we're seeing that we're purchasing it. Let's make a timeline so we don't get confused. We're dealing with September 1st, and we are at December 31st. If we count those months, that's 4 months. Now we know that the amount that we have lent out was $12,000. at a 5%, which means times 0.05, this is equivalent to a 5% annual interest rate. We only used 4 out of the 12 months, and therefore we have a total amount of 200, which we can simply add in to the journal entry we prepared. Now, let's move on to part C. So the balance in the prepaid rent represents payment for 12 months beginning August. So we have prepaids for rent, prepaid rent, and it's at August 1st. So now we've used a certain amount. So again, this is our adjusting journal entry. We are going to debit our rent expense because now we've used some of this prepaid rent. And we are going to credit, we need to decrease our prepaid because now we've used some. So once again, let's draw a timeline. Here we know we're looking at August 1st until December 31st. This amount is 5 months. Now, if we look back at our accounts that are given, our prepaid rent is told to us to be $8,400. So let's go back now that we know the amount. And we know that at $8,400, we've used, this was for a 1 year rent, prepaid rent, so we used 5 out of the 12 months. Therefore, we used $3,500. That's how much we've used of our rent. Let's look at part D. We have equipment whose useful life is 20 years, no residual value, and there is no depreciation recorded for this year, and it uses straight line. So we need to record our depreciation expense. Let's look at how much our asset is worth. The equipment here costs $30,000. So if we know that our equipment costs $30,000, let's go add that in and make a journal entry. So at December 31st, 2010, we need to debit our depreciation expense, and we need to credit our accumulated depreciation for our equipment. How do we know how much? Now we need to calculate using the straight line the depreciation expense. So here we know that the depreciation expense, we have an asset worth $30,000 with 0 residual value, and we divide that by the useful life, which we were told is 12 years. Sorry, excuse me, not 12, 20 years. So let me just fix that. So we're dealing with 30,000 minus 0 divided by 20 years. This gives us an amount of $1,500. That's our yearly depreciation. Now, this question we're going to come back to because they do ask us to calculate, so let's keep this one in mind. And let's move on to question E. They said that they were going to be paying 50 cents cash dividends that was declared on December 31st, but will only be paid on January 25th. So since, again, we follow accrual basis of accounting, not cash basis, we need to record it, but we're not decreasing our cash just yet. So we have dividends of 50 cents per share. We need to know how many shares. It's mentioned right here. If you look under shared capital, right here, we have 15,000 shares. Now we can go back and we can make our adjusting journal entry. So for E, we're looking at just, again, we've declared at December 31st, 2010. we've declared dividends. Now, there is an option, depending on how your teacher explains this, to go straight into retained earnings. Usually dividends is an account that we will close in our closing entries to retained earnings, but you can either create an account and then it'll be closed later on, or we can simply go straight to retained earnings. You should ask your teacher or your TAs, and they'll tell you which one is accepted or preferred. And we're also going to credit our dividends payables, which will be paid in the following year. Now we need to figure out how much we need to pay out. So we know we had 15,000 shares at a 50-cent dividend per share. This gives us 7,500. And we just simply add that in to our entry. Now, let's look at part F. So our allowance for doubtful accounts are increased to the amount of 1,200. So they're not increased by a certain amount, they're increased to a certain amount, which is important to note. So this is our closing balance of our allowance for doubtful accounts. And we need to make sure that it's up to date. So let's go see what our balance currently is. Our allowance for doubtful accounts are currently at 900. So we need to adjust for that. So we know we need to increase. So we're going to, once again, at December 31st, 2010, we know we need to make a debit on our bad debt expense. And we need to credit our allowance for doubtful accounts. Now we need to figure out how much. So what information are we given? We're told that in our T account for allowance for doubtful accounts, we began with 900. Remember, this is a contra asset account, therefore it has a credit balance. And it needs to have a closing balance of 1,200, which means that there's a certain amount that was added in here. To figure out that amount, we need to do 900 plus the amount that we added in is equal to 1,200. If we solve for this, we get that this is $300, which means that our bad debt expense should be 300 and our allowance for doubtful accounts will be increased by the same 300. Now let's look at part G. We are subject to an income tax rate of 20%, and it's due in March. So one thing to note when we're going through this is, as it was mentioned at the beginning of the question, we should always note what our prepaids are, because they tend to be involved. We had our prepaid rent, and we have prepaid income taxes of 520. This is going to come into play. So we can prepare the adjusting journal entry, but we can't record it just yet because we don't have the total income, our net income yet, so we can't calculate it. So that's going to come in requirement number 2, but we can prepare our adjusting journal entry and come back and fill it out. So we know that we are going to have an income tax expense we're going to have an income tax expense, and we are also going to use this prepaid income tax account, and we are also going to have an income tax that's payable. Now, the amounts we don't know. The only amount we do already know, if there is an income tax payable, would be the prepaid income tax, but we'll leave it blank for now, simply noting that it's going to be our net income multiplied by 20% to give us. So we'll come back to that and we'll solve it we'll solve it at the end of requirement number 2. So for requirement number 2, we need to prepare an income statement, which has already been laid out here. The format is something that every student should be able to prepare on their own. It will not be provided during the exam. However, there are a few things to note and to make sure not to mix up. We're looking at an income statement. When we're looking at an income statement, we look at for the year ended. It's very important to know that. Compared to a balance sheet where we do it as at of a certain date, it's a screenshot of the accounts at that date. This is a summary at the end of a term, at the end of a business cycle. So here we are looking at our revenues and our expenses in our income statement. But before we do that, there's one thing that we should be doing is taking all of these accounts that we have just added in or adjusted in our requirements and add them in and adjust our unadjusted trial balances. So if we were to do this, we need to start by adding in all of the accounts. This probably will not be laid out this way on the midterm, but I highly recommend that you create extra lines and you add in your accounts and you adjust your balances. So in this case, let's create, this was a debit and a credit, and we can do that again. Once again, I'm writing this in just for simplicity's sake, but this shouldn't be something that needs to be clarified. It should be something that's second nature. So I'm going to go through just the first few, and then I'll do it a bit quicker. So when we're looking at wages expense and wages payable, we have $4,000 that were added. So we already have a wages expense right here of $4,000 that needs to be added, but we do not have a wages payable. So let's create a new account called wages payable, and let's create that with a credit balance of $4,000. Okay. Now, if we go into part B, we have interest receivables and interest income of $200. So if we look through it, we do not have interest receivables or interest income. So let's create those two accounts. So interest receivables, interest income, and let's go on to the next one. We have rent expense and prepaid rent that we need to adjust for $3,500. So we already have here prepaid rent needs to be decreased by $3,500, and rent expense needs to be increased by $3,500. So let's keep going. So rent expense is done. Depreciation expense and accumulated depreciation need to be adjusted for $1,500. So accumulated depreciation needs to be added at $1,500, and we know that no depreciation expense was recorded, so depreciation expense needs to be added at a total cost of $1,500. Now, we know that for the next, now the next one was the dividends and the dividends payable. So we can see that we don't have these accounts, so let's create them. So here we have the dividends of $7,500 and the dividends payable of also $7,500. And then we have our bad debt expense and our increase in allowance for doubtful accounts of $300. So here we know we have an expense at $300. And we can also go into our allowance for doubtful accounts and add in $300. Now for the last one, we have our income tax expense, our prepaid income tax, and our income taxes payable. So we know we are going to have an prepaid income tax that will be adjusted, but we just don't know by how much yet. We have to calculate it. We have an income tax expense, and we could have, if we go over the prepaid income tax, which is highly probable, we will have an income tax payable. Again, the amounts will be adjusted later. So for now, let's just adjust all these accounts that we have here. So that's 6,000, 100, so all I'm simply doing here is either, if there was no adjustment, rewriting it just so that I have all of my accounts clearly listed here. On the exam, if this takes too long for you, by all means, if you're able to not rewrite every account and simply highlight the ones that were adjusted and write in the new balance, please feel free to. If not, then go through this step. Just note your time, because time is limited during these exams. So only do what is absolutely necessary. We're going to come back to this one. Almost there. And there is one more thing I will add in to help prepare the financial statements, is to properly label which account goes into what. So on the side, let's pick a color that we can clearly see. We could label all the accounts that will be included in our income statement, which means any accounts that are involved in revenues and expenses. And since we're also told that we need to do the asset section of a balance sheet, therefore we can also label those. So accumulated depreciation will go on we have an accumulated depreciation, which is a contra asset account. We have an allowance for doubtful accounts, a contra asset account, an asset account, which is cash. Cost of goods sold is an expense, so that goes on our income statement. So let's write an income statement. We have deferred revenues, which will be a liability, which we do not need to work with, so we can leave that blank. Equipment is an asset. Merchandise inventory, that's an asset. Miscellaneous operating expenses. Expenses go on our income statement. A note receivable due December 31st, 2011, that's an asset. Prepaid income taxes would be an asset, however, we're going to leave it blank for now. We don't know if it'll still exist once we've calculated our income taxes. Now we have our prepaid rent, which is an asset, and our rent expense, an expense, goes on our income statement. Retained earnings, which would have gone on our balance sheet, but we're not going to be doing that part of the balance sheet. The sales return on allowances, that's going to go on our income statement. That is going to affect our net initial sales. Now we have our sales revenue. Our sales revenue is also going to go on our income statement. Our shared capital, our trade payables, we're not going to be dealing with in this question. Our trade receivables are an asset. Our wages expense are an expense. They go on our income statement. Wages payable are a liability. And interest revenue is an asset. That's an income, which is a revenue. A depreciation expense also goes on our income statement. Our dividends we're not going to be using here, and our dividends payable either. Our bad debt expense is an income statement. Our income tax expense goes in our income statement, and our income tax payable we won't be looking at in these questions. So now that we've labeled, you can clearly see that the accounts that I've labeled will show up on the income statement. So now that you've seen which accounts go in, we start by income statement is to calculate our net income. So we need to start with the amount that we made. The amount that we made in this case was our sales. So let's put in our first dollar sign to show that this is all monetary values. And then we have sales returns and allowances, which we said were a contra revenue account, which decrease our revenue by $2,200, giving us a net sales of $148,300. We have our cost of goods sold, which is an expense account. I'm getting all of these numbers from the balances that you saw me adjust just a few minutes ago. And we end up with a gross profit of $83,800. Now, our operating expenses, let's just add them all in. We've already calculated the total on the first page, so let's just write them right in. I'm simply copying down the numbers that you've seen in the first part of the question. All of these numbers here that were associated with accounts that have income statement in red next to them are now being added in. The balances are simply being put in into our income statement. So we end up with a total of $71,400. We need to subtract this from our gross profit, our total operating expenses. This will give us an operating profit of $12,400. Now, it's important to note that these are our operating expenses. These are all the expenses that are required for our operations. Now, interest income does not go into this account, and therefore it needs to go into other income. So as you can see here, there are certain incomes and revenues that will go into other incomes and other revenues and expenses. So interest income is one of them. So we need to subtract that once again. So interest income, is a revenue, so it's going to be added to our total, giving us a profit before taxes, $12,600. Now we need to calculate our income tax expense. So how do we do that? Is our income tax expense will be $12,600 with a rate of 20%, which means to multiply by 0.2, giving us $2,520. This is equivalent to a 20% income tax. This means that we have to subtract income taxes of $2,520. Our profit for the year will be $10,080. And then we need to remember that our earnings per share needs to be included, even though it's not mentioned. It is part of the income statement and must be added in. So to figure that out, we look at our profits for the year and we divide it by the number of shares, which we had already seen when we calculated our dividends to be 15,000. This gives us 0.67, which means that our earnings per share are 0.67. It's important to double underline this total to show that this is our profit for the end of the year. And now what we can do is simply go back into our adjusting entries that we did before for question 1 and complete our income tax expense. We now know that our income tax expense was for $2,520. We do know that our prepaids were at $520. So here we know that we had to calculate, once again, I'll write it down, at a rate of 20%, gives me $2,520. And then to get the income tax payable, we simply subtract it from 520 and get 2,000 and just put that right in there. We can also go back into here and adjust these accounts. So this would be minus 520, giving us a balance of 0. This would be at a balance of 2,520, and this one would be at a balance of 2,000. Now we've just updated all our accounts. We do know that this one will not be included on the balance sheet, and that's exactly what we're going to prepare next. So to keep going with this problem, we are now looking at the statement of financial position. That's our requirement number 3. Now, to take care of this requirement, we are going to once again simply look at the accounts that we have already labeled in red that have assets and contra assets. These are the accounts that will be included on the assets section of the statement of financial position. Now, once again, this format, there are a few things to note. It's a statement of financial position. It's as at of a certain date because it's a screenshot at that date. Your current assets will all be in the order of liquidity. This means that we go from the most liquid, the easiest to convert into cash, which is of course cash, to the least liquid. So once again, there's one more thing to note, is the trade receivables, which are put as net, which means that they are equal to the trade receivables minus the allowance for the doubtful accounts, which is our contra asset account for this one. Now, I'm simply going to put in, I'm not going to flip back and forth, it's not necessary, just putting in the numbers. So our cash was at 5,300, and our net trade receivables, which here I can add in the calculation, which was done at 50,000 minus 1,200. And then we have 8,000 for the next one. Giving us a total of $79,200. This is our total current assets. Long-term assets, let's look at our equipment. Let's just indent it 1 at 30,000, which we had seen, with an accumulated depreciation now at 6,000, giving us a total long-term assets of 24,000, giving us total assets of $103,200. And that is our statement of financial position. Pretty straightforward. So long as you just need to make sure that once again you know the order of the liquidity, that the trade receivables were put at net, it's as at a certain date, and that's about it. And let's move on to requirement number 4. Now in requirement number 4, we're asked to figure out the remainder of the useful life of the equipment that we have purchased. So let's try and figure out when we purchased it. So based on the information given, we know that we are looking at a 20-year period over here. Now, we have one date which is given to us at December 31st, 2009. And here we have December 31st, 2010. For here, we have accrued a depreciation expense of 1,500, correct. We also know that from here to here, we have an accumulated depreciation before we added the one for this year, which is 1,500. It was 4,500. How do we figure out how many years this is? Well, let's see. If we have 4,500 divided by 1,500, we end up with 3, which means that 1,500 multiplied by 3 will give us 45,000. So we know that we have a total of 20 years. Our first 3 years were before 2009. 2010 was the additional year, which means that as at December 31st, 2010, we have 16 years left of useful life for this equipment. And now let's look at requirement number 5. In requirement number 5, we are looking at ratios. So the first ratio we need to calculate is our net profit margin ratio, which is equal to our profits divided by our net sales. So if we go back, we can see that our profits are on our income statement, correct, right here. These are our profits. And we also know that our net sales are right here. So let's simply put these numbers into that formula and solve. %6.8%. What does this mean? This means that we make 6.8% profit for every $1 of net sales. So out of every dollar, 6.8% is turned into a profit. And now number 2 would be the total asset turnover ratio, which is equal to our net sales divided by our average total assets. Our average total assets over the last 2 years, which we were given at the end of the problem on the bottom of the page. So we already know our net sales. We know that we were told before that we have $100,000 dollars of assets as at 2009, and we also know that our total assets for 2010 were the ones that we found in our balance sheet of 100. Let's just fix that right there. If we divide it by 2, that's our average. This equation will give us 1.46. What does this mean? We earn 1.46 of sales for every $1 of assets that we own. So for every dollar of asset that we own, we're able to make $1.46 in sales. This helps us see how efficient our management is at using our assets to generate sales and therefore profits. So this gives us our management effectiveness in generating sales. So once again, we've completed requirements for 1 through 5. If you have any further questions, this was a bit of a longer question, so I recommend you go to your teaching assistants or your teacher and they will give you more further clarification.